Founders Forum, episode 19.
Open your mind to a new episode of the Founders Forum, the podcast championing a free economy, sound assets, and blockchain solutions. Each week, your hosts, entrepreneur Cole Snell and economist Bob Murphy, interview pioneers and free thinkers to help you develop into the architect of your future.
Hey everyone, welcome back to the Founders Forum. Today, Cole and I are going to be speaking with Jeff Snider, who we recently saw speaking at the Rebel Capitalist Live event in Orlando. So you might remember a few episodes ago, Cole, Alec Beckman, another Infineo team member, and I were speaking from a hotel room discussing the event in real time, as it were. But anyway, Jeff was one of the speakers, and his topic was on so-called natural rate of interest that economist Knut Wicksell discussed, and he sort of popularized this concept. Incidentally, it was also used, Ludwig von Mises incorporated the idea somewhat into his own theory of what caused the business cycle. So anyway, in Wicksell's framework, at any given time, there's a natural rate of interest in the economy corresponding to the fundamentals, if you will. And if the commercial banks conduct their policies such that the market rate of interest in practice is below the natural rate, then that leads to rising prices. It's inflationary. And on the other hand, if the interest rate is higher than the natural rate, then that's like a tight policy. And that, Wicksell argued, was you could tell that was the case if prices were falling. And whereas if you had steady prices, stable prices, then that was consistent with the actual market rate of interest equaling the natural rate. All right, so that was his framework, and then economists have taken that. And so in practice, what that can mean is, for example, after the 2008 crisis, when the Federal Reserve cut interest rates eventually basically down to zero, if we're talking about short-term rates, there were economists who were saying, some people were freaking out, like, oh, wow, interest rates are really artificially low. This is crazy, this easy money Fed policy. We're going to have hyperinflation any day now. But some economists were saying, well, no, given the bleak prospects now in the global financial system, the natural rate of interest has fallen off a cliff too. And so it's not that the Fed and other central banks have pushed interest rates down to artificially low levels. It's just they're sort of following the market, or that's what it's supposed to be. That's the idea. Okay, last thing I'll say before I read the bio here. I personally do not necessarily endorse everything Jeff is going to say in this interview, but he does present a sort of contrarian view to a lot of the attitudes that are popular among the demographic that this podcast probably caters to, of people who are very skeptical of central banks. Jeff is too, by the way. He's not a fan of central banks, but the idea is, even though he shares a lot of sympathy with that mindset, there's a few particular popular attitudes among that group that Jeff actually thinks are wrong. And that's what I wanted to make sure you folks had a chance to hear in this conversation. So as far as his bio, Jeff Snider is host of the popular Eurodollar University podcast, one of the foremost experts on the global monetary system, specifically the Eurodollar reserve currency system and all its grossly misunderstood intricacies and inner workings. An independent monetary scholar and researcher who is fluent in repo, securities lending, derivatives markets. As such, he is a regular contributor to Real Clear Markets, is active on Twitter, and has been a guest on countless financial media programs and podcasts. So without further ado, here is our discussion with Jeff Snider. Well, Jeff, welcome to the Founders Forum podcast.
Hi, Bob. Thank you for having me. Really looking forward to this.
Yeah, we are too. So Cole and I were both recently at the Rebel Capitalist event in Orlando, and you were one of the featured speakers there. So maybe that's a good place to start. You were telling the crowd about the natural interest rate. And so what's that all about?
Well, it starts from the fact that we get interest rates backwards because we're taught, the message is reinforced all the time. First of all, that interest rates are really easy. The Federal Reserve controls all of them. Therefore, if the Fed hikes rates, that means the economy is going to be tightened through some kind of magic in the credit markets. And if the Fed wants to boost the economy, all it has to do is just lower interest rates. When in historical experience, that's backwards. That's not how interest rates work at all. And you get further into it, the Fed really doesn't have as much control as you think. They might be able to influence a small part of the yield curve, and only in the short run. And then interest rates are independent and free to go where they want. And if rates overall go up, that's usually associated with inflationary periods, not the other way around. And if rates go down and want to stay down for a prolonged period of time, that's depression. And so the message I was trying to tell people at Gammon's Rebel Capitalist Live was essentially, you got to look at it historically speaking, what interest rates are telling us, not what the Federal Reserve wants us to believe about what interest rates do.
Okay, so it seems like you're making at least two separate points there that, again, kind of, and the reason I was telling Cole I wanted to have you on this podcast is because a lot of what you say is sort of against the groupthink of like the sort of hard money crowd, people that like gold, that like Bitcoin and so on. They're skeptical of central banks. So I like how you're very sympathetic to their perspective.
Skeptical of central banks.
Yes, right. So I want people to understand your point's not that, oh no, Bernanke and Powell and Janet Yellen, they're all great people and have our best interests at heart. That's not what you're saying, but you are saying be careful. There's some sort of tropes or whatever in that crowd that, maybe need to be disposed of. And so one thing you're saying is central banks actually don't have as much control over interest rates as a lot of the critics sometimes think or believe. And then also another point is that you're saying people tend to look and they say, oh, the fact that interest rates were really low, let's say from 2010 onward, that must have meant that the Fed and the ECB and so forth had a really easy money policy. They were just flooding the market, and that's why credit was so cheap, because they were just pumping credit in, and that's why interest rates were pushed down to artificially low levels. Are you saying you think that's a false statement?
No, I'm not saying I don't think it's a false statement. It is a false statement.
Oh, okay. All right, fair enough. You're confidently saying it's false.
Yes. Yeah. And it's, the funny thing is, because people don't know economic history, the Federal Reserve made the exact same mistake, as I brought this up in my presentation. They made the exact same mistake in the early 1930s. They even said in their annual report that because interest rates were low and because the Federal Reserve pursued a policy of low interest rates, that they had accomplished an easy money program. And they even said, we bought government bonds, which made it an incredibly easy money program during the early 1930s. So even from that example, you can see it doesn't work the way you think it does. Buying government bonds, interest rates going down, that's what the Fed does, but that doesn't make it necessarily easy money. And what history has shown over and over and over again is that when interest rates, especially on safe investments, go down, what that means is that in the marketplace, safety and liquidity are in high demand. And what types of conditions would we associate with safety and liquidity being in high demand? It wouldn't be easy money. It would be the exact opposite, which is why you see interest rates that we can measure and observe, like government bond rates and high-grade corporate credit rates. Those went down during the 1930s, not the other way around. Versus, say, the 1970s. The 1970s, great inflation. Where did interest rates go? They went up. Not because the Fed drove them up, but because of what Newt Wixell was talking about with a natural interest rate. When we're in a nominally inflationary economy, that means that you can get lots of good returns in the real economy. Therefore, demand for money is relatively high. So people will pay high interest rates to borrow funds because there's opportunities in a nominal economy. And even interest rates on safe investments will go up too, because safety investments then have to compete for money that is being used more and more as it's circulating throughout the economy. So as Milton Friedman said numerous times in his career, he called it the interest rate fallacy for this reason, because economists, central bankers, politicians, everybody, we always get it backwards when in historical experience, low bond yields, low interest rate yields, high demand for liquidity and safety is the opposite of easy money.
Bob, I want to jump in really quick and ask Jeff if he remembers the last comment of your presentation at George's event in Orlando. You had one sentence at the end that it was a good closer. Do you remember what it was?
I have no idea.
I don't even know if I remember what it was
at all.
Yeah.
Hey, Bob, you remember what it was?
Thanks, everybody.
Yeah, that's it. That's all it was. Yeah, that's it. That's a showstopper. No, it
better than the alternative.
Yeah,
you guys suck. I'm leaving.
Yeah, it was. No, you crushed it. Actually, the thing that your presentation was amazing, but your PowerPoint slides were. If anyone, I think George is putting everybody's presentation or the whole thing is live on YouTube, or it's up on YouTube now. But you have to see Jeff's PowerPoint presentation. You really were crafty, and I could just see you at home either you're really good or you spent a lot of time building that. I'm not sure which one, but it was really crafty.
He's saying Jeff with like all your, like Excel coming in and George's face coming in on the PowerPoints and such.
Right. And people getting blown up. And yeah, it was awesome. Okay. So the last, I think it was something about the rates. They said, and so, okay. And all of you spoke for like an hour and you're like, okay. And all this to say that rates being, it was high or low or not. I think it was high rates aren't bad, essentially is what you said and I was just kind of looking at him going, this guy's awesome.
If things were going in the right direction, if we were actually recovering from the 2008 crisis, which we still haven't recovered from, then interest rates would be rising on their own, not forced up in an attempt by the Federal Reserve to try to create some kind of braking mechanism on an economy that still needs more credit, not less. That's another fundamental thing that we get wrong. We all think that we hear this term, everything bubble, tossed around carelessly all over the place because we associate, again, low rates stimulated a lot of credit. Well, no, the low rates were the recognizing that safety and liquidity were in high demand because money was in tight supply. Therefore, credit was also in tight supply, except for the government. Government credit exploded while private credit absolutely shrunk and contracted. And so we have this idea, again, thinking about the Federal Reserve balance sheet, thinking about the federal government's activities. If you focus entirely on the public sector, it looks like the Fed blew this massive government bubble, when in fact, the real economy, the real marketplace, the credit statistics, everything, banking system, banks all shrunk their private activities because of the liquidity problems, the lack of money in the monetary system, the real monetary system over the last 15 years. And so if we were getting out of that situation, moving into an actual recovery where the financial system was becoming more normalized or more normal like it should be, then we would see interest rates rise. We wouldn't see the yield curve inverted fighting against the Fed's rate hikes. It would go up on its own because that would tell us that growth in inflation expectations, more growth than inflation, but either one of those were actually rising rather than what they did do, which was the Fed push up into short-term interest rates and the long end of each yield curve, not just in the US, but around the world, fight against that, going back towards zero again, because we haven't really left that tight money situation.
So just so I understand your framework, are you like, they'll say, oh, the Fed voted to raise interest rates. And what people mean by that, of course, is, very short-term rate, like specifically the Fed funds rate is what they target now. Are you agreeing that, yes, the Fed, at least in the short run, can raise short rates, but you're saying what happens on the long end is determined in the bond market and the central bank can't directly control that? Is that correct?
That's correct. And I would go one step further. I would say that the Fed's control over the short end is at times tenuous too. It isn't as simple and as mechanical as they make it sound. We see that in any number of ways, including treasury bill rates that are well below the Fed's floor, which is the Fed uses the reverse repo as their floor mechanism. They actually have a double floor mechanism, but nobody cares about IOR these days. But you see interest rates that disobey. I mean, treasury bills are monetary alternatives as it is. So in the big picture sense, the Fed has somewhat more solid influence at the short end of the yield curve because it makes sense. If you're in the money markets and the Fed is offering you, say, 5.05% of the reverse repo, you're going to take that into account when you're evaluating other alternatives such as treasury bills or repo or something else like that. So the Fed does have some sizable influence at the short end of the yield curve and the money rates. But it gets real questionable real fast the further out the curve you go. You look at something like the 2-year instrument. If you're owning a 2-year treasury, you're going to pay attention to what you might be able to get in repo or some short-term alternative. But at the same time, you've got your eye on longer-term factors like growth, inflation, demand for safety, and liquidity, which is why we see the 2-year going way up and way down all the time because it seems to be caught between these two conflicting narratives. The one is, what is the Fed going to do in offering reverse repo floors and other money alternatives? And the other is, what is the bond market actually thinking in the long end of the yield curve right now when it's hugely inverted, which means, again, high demand for safety and liquidity in the future. So this was exactly what Alan Greenspan was talking about in 2005 when he used the term conundrum. Because what we're all taught and what Alan Greenspan believed was, if the Fed raises the short end of the yield curve, the entire yield curve should move up in lockstep. He even called it a series of 1-year forwards. If the Fed raises the first forward, then every single yearly forward after that, every single maturity on the treasury curve should rise in exactly the same way as the Fed wants it to. And that's what we believe. We're taught to believe that in the economics class. We're taught to believe that by everything you see on the financial media. But as Greenspan was pointing out, 18 years ago, it wasn't working out that way. The Fed at the time was raising interest rates like it's doing now, not as aggressively, but still they raised rates more than they have, or almost as much as they have today. And the long end of the yield curve was saying, no, we're not buying it. Long end rates actually went lower through all of those rate hikes. They moved a little bit higher toward the end, but by and large, rates at the long end of the yield curve weren't buying it. And we've seen this happen every rate cycle since then. In 2018 and 2019, the yield curve flattened out, inverted again. And it happened pretty early on last year. You go back to March, the yield curve inverted, which was the long end showing you that it is independent of the Federal Reserve.
There was a series of bank failures a few months or a month or so ago, maybe 2 months ago, over the last couple of months. I think it started with like Signature, Silicon Valley Bank, Signature, and then First Republic was the last. There's one more. There's a fourth one in there I'm forgetting.
Credit Suisse.
Well, yeah, just that one, right?
Yeah, don't forget that one.
Yeah. And so maybe the first one, they're like, oh, there's a conspiracy. So I've heard these conspiracies. I don't even know if it's a conspiracy. It may not be a conspiracy. It may be fact. I guess we'll see. That the Fed is kind of positioning JP Morgan to be like America's bank, like one bank, kind of like the Canadian system where they have like 4 banks, but they're not banks at all. They're just like tentacles of the Canadian Fed, essentially. And so the argument is that America has too many banks. So let's just peel a bunch of these banks off. Let's start with the 4 that we just listed. Well, Credit Suisse is not an American bank, but you kind of get the point. If there is one bank and it's called JP Morgan, how does this all relate to it? What do rates look like when there's one bank? Are they high? Are they low? How does this factor in if this conspiracy is true?
Well, the conspiracy isn't true. So let's just start with that. Okay. The banking system has enormous problems that it's going to sort through. And of the 4 banks that you've mentioned, Credit Suisse is important, which shows this is not just a U.S. phenomenon. This is a global monetary phenomenon, which is why the yield curves are so damn inverted to begin with. It's not just about the U.S. banks. It's not just about U.S. regional banks. And it has very little to do with the Fed's rate hikes. But if we ever got in a situation, let's be honest here, I think JP Morgan, Jamie Dimon in particular, is sitting back and smiling at the prospects of this. He doesn't need the Fed to tell him or the federal government to tell him to bail out the banking system. He's only too happy to have these regional banks fail so he can come in with government support and scoop up all the worthwhile assets that are left behind. He can pick through the carcasses as he wants to pick through whatever's left of each of those institutions. So I think JP Morgan, I think a lot of the larger banks are only too happy for something like this to happen. Whereas in 2008, it was the larger banks that were under the gun, so to speak. And I think that tells us something about the nature of the monetary system and the nature of the banking system to begin with, which is that it is by and large a large cartel anyway. It's run by a small group of large banks, the entire monetary system, and it's been this way for more than half a century, which, as I think we're moving toward here, that's not ideal. And if it's, a smaller group of banks in that cartel, it only makes things much more rigid, much more inefficient, much harder in the real economy. Obviously, the banks in the cartel will be able to extract more rents from the system, which, that's good for them and bad for everybody else. So, yes, I think most of the big banks who are not really affected by the banking crisis, and it is a very real banking crisis, those who are not affected by it are sitting back and saying, this is terrific for us because we're letting this banking crisis eliminate our competition, which will give us more privilege, more power, more influence, and more unearned profitability, which is why people hate the banks to begin with.
So do you foresee continued consolidation and like smaller banks going down one by one, or have we gotten through the worst of it, if you had to guess?
No, there's much more to come. And the reason we're getting to consolidation is simply because authorities don't know what to do to fix this. And so their short-term Band-Aid solution is to take a bad bank that's on the brink of insolvency and merge it with a good bank that isn't. That's all they know what to do. They can't fix the systemic problem. So they're left with, well, how do we stop the crisis? We don't know what the crisis really is. So let's just make sure that no more banks fail. Or if they do fail, they have a willing partner. It doesn't lead to something like Lehman Brothers, where we're just exposed to naked bankruptcy problems. So let's just take small banks and merge them with big banks, which is why Janet Yellen was caught talking about this with a couple of weeks ago. She had the Wall Street CEOs that are part of that one advisory board in, and they leaked how they were talking about, there's going to be more mergers ahead. Because in the official view here, what needs to happen is we need to get people to stop talking about the banking crisis. And the only way we can do that is by just merging whatever bank name comes up, whether it's PacWest or what is the other, Bank of Hawaii, or some of the other ones that have come up, the ones that have been downgraded. We'll just merge them with JP Morgan or somebody else at a real cheap price, if only to get the public to stop talking about the banking system, because they don't really know what's going on here. And they're just kind of throwing stuff at the wall, hoping something gets fixed, when that's really, again, the markets and interest rates are telling you safety and liquidity are about to be in huge demand. And a banking crisis that gets worse would be very much consistent with what the markets are forecasting.
All right. Well, let's talk about another crisis really quickly here. So we talked about, but there's a banking crisis, and this will circle back. So I mentioned 3 banks: First Republic, Silicon Valley, Signature Bank. Let me list 3 blue chips really quickly: Bud Light, Ford, and Target. And I don't know if you know where I'm going here, but it's a woke versus based kind of comment. So if you mentioned, you didn't say IMF, but I'm going to say IMF. You kind of indirectly said IMF. So the internet, so you have IMF, you have BlackRock, you have then banks, and you have environmental social governance pushing down these agendas. Are they the ones telling, there's no conspiracy, you said there's no conspiracy on the banks. Okay. Now, is there a conspiracy with this pipeline? IMF, banks, throw BlackRock in there with ESG, Bud Light, Ford, Target. And I'm just going to assume we all know when I say Bud Light, Ford, and Target, what we're talking about, right? For the listeners, maybe I'll let Jeff kind of comment on this, but it has a lot to do with kind of go woke, go broke. Essentially, this is like Bud Light losing 9 billion market cap, Target something like 9 billion these numbers are, I'm pulling these, something like that. Ford, I don't know what it was, but it's up there. So, why the heck are these companies doing it? And is it a IMF telling the banks, and the hedge funds, the IMF telling the hedge funds telling the banks telling blue chips to start selling weird stuff putting weird stuff on their shelves and weird people on their beer cans?
I think it's more of a political story that leftism as let's face it, leftism has infected a lot of public institutions, and leftism seeks to impose itself in every corner of society using every avenue that's available. And if you're in that sort of mindset, the most powerful, or one of the most powerful avenues to exercise control over the economy is what? Money in banks. And so banks have, again, it's going back to this cartel structure that we've had for many years.
All right. You said cartel, right? I said IMF, you said cartel, right? That's perfect. Got it.
It's a cartel, and it's not just global banks. There's also supranational organizations that are involved in it too. There's a mix of public and private interests and everything else. So you have this banking cartel that has enormous power and privilege. Of course, you're going to try to influence it as much as you possibly can, because if you can co-opt that, you can then influence everything else below it. Or at least if you don't influence it, you can always wield that weapon, as we saw in Canada, right? If you don't think and act the way we want you to, we're going to cut you off. We're going to cut you off in credit. We're going to cut you off from the monetary system, the digital economy. We're going to do all of these types of things. We're going to institute a Chinese social credit program because we have the ability to do that. And that's kind of what we're really talking about here, is that as these leftist politics have infected these organizations, they're moving the corporate structure toward a social credit score, which means they have to comply. Otherwise, the leftists are going to use as many tactics as they possibly can to enforce whatever it is that they feel that they need to make sure that their Marxist revolution gets to its final completion, because that's what they're really working toward. And the banking system, from their perspective, they're just looking for political cover. The Federal Reserve in the same way. Why do you think the Federal Reserve is talking about climate change? Because the Federal Reserve gets on board with climate change, maybe nobody looks at this interest rate stuff, or nobody takes a harder look at quantitative easing. It's much easier to fall in line where you think politics are going than to avoid accountability. I think that's also the same thing that's happening in a lot of banks in corporate America too, is that it's just a path of least resistance. Why fight against this massive wave that's coming? Let's just get in line and hope everybody just kind of leaves us alone, or it kind of goes away, when we know that's not really going to happen. It's like any bureaucracy. Once you take hold of any power, you're never going to give it up willingly.
So, Jeff, just to piggyback on what Cole was saying there, again, you can't get inside the heads of people or whatever, but for certain critics to be like, whoa, Target, what the heck were they thinking? These idiots, they don't know their own demographic. Bud Light, they don't know their own customer base. What's frat guy? What are you, crazy? You're saying, no, it's not that they're stupid. Maybe they miscalculated, but no, that's a very rational thing. They're looking ahead and saying, 5 years from now, we want to be, have been on the forefront of this stuff because it's going to be more apparent in 5 years why the companies that are on the right side of history are going to be okay, whereas the ones that weren't are going to all of a sudden find bad things happening to them.
Yeah, you don't want to be on the opposite side. Everybody always wants to be on the winning side, and if it looks like that side's going to win, you're going to get involved with it as easy as or as soon as you possibly can. And let's not forget too that a lot of corporate America has been infected with tons of true believers. These people don't care about their customers. They don't care about the companies at all. They're working in these capacities because they have a different alternative agenda. They've all come through these indoctrination mills, universities, what used to be universities, and they come out the other side as revolutionaries.
Yeah.
And they're enacting their revolutionary agenda using every available power structure that's available to them, which, the banking system, monetary system is about as powerful as you can possibly get outside the force of law. It's all very Maoist on purpose because this is following the Maoist template right down to a T, including co-opting those who don't actually believe in the same things that you do. And it's really easy to do that when most people they just want to drink a beer and go shopping. They don't really care about these kinds of politics. But yet, if you're forcing the company to think about that, then you're forcing people who shop at that company to think about it too. There is an agenda here. I don't think it's necessarily a conspiracy as it is just the naked revolutionary tendencies that the left and Marxists have been trying to gain and trying to do and try to accomplish for generations. It's just that over the last 15 years, and this is not an accident, really since interest rates went down and we went into this silent depression, people have been more and more susceptible to the idea that maybe this capitalist thing has run its course. Right. Maybe we need to be more open to socialist ideas because I look at this economy and Jay Powell tells me it's wonderful and great. I don't see it. I see nothing but, massive imbalances, massive inequality because Wall Street's doing really well, but the regular worker sure isn't. And it's much easier to sell this type of agenda to people who are looking at the current situation and saying, this is good. This is not good. And I think it's a confluence of several factors. The bad economy, no answers to why the economy is bad. So people are quite naturally looking for different answers, even if those answers are more extreme than they had ever been.
Yeah, I'll say 3 more things: COVID, fentanyl, and TikTok. And the reason I say that, because COVID is like to your point. And so for the listeners, when Jeff talking about Marxism and various things, we can just talk about kind of like keeping people controlled, keeping them kind of numbed out. COVID did a really good job of that. Work from home, you can be lazy, keep people soft. I'm kind of weighing in on my opinion right now a little bit, but there's this woke agenda. And then, fentanyl, the Chinese forcing fentanyl into America. It's like a silent killer. It's like launching a nuclear warhead in a country. It's so addictive. It's killing people. It's just, again, making people weak, numbing them out, making them comfortable, making them soft, killing people. It's amazing. I've been to San Francisco last summer. I went to Vancouver, Canada last summer. And until you're actually on the front lines of like what fentanyl is actually doing to people, you have no idea. And then there's TikTok, right? You go to other countries in the world, you don't have exposure to essentially like the softcore porn that is on TikTok and the dopamine hit that you get from watching this. And it just like literally is addictive. Like I experiment with myself. Like I'll feel tired at night. I'll put myself on TikTok and I'm just getting blasted by dopamine. I'm like totally absorbing this stuff. And I literally have to pull myself away. And I know how bad it is for me. So I could just see people just being numb, being soft, flipping through this. And then they're just kind of so oblivious and uneducated and unaware to all of the things that you're talking about. And that's the thing that blows my mind. Is that the average person, and this is what they want, this is what the left wants, is they want people to not be able to understand you and Bob, right? Because most people can't understand you guys anyway, right? Really, but they don't. But imagine if everyone could understand the two of you, right? That would be really bad for the left. And so all of these 3 things, I keep talking in threes here, but these last 3 things I'm talking about are doing a great job of keeping people soft, as far as I'm concerned.
Whether it's an agenda, whether it's, there's an intent there too. But again, the confluence of events have been perfect so that these things can just It's almost like the perfect habitat for this type of experimentation or this type of meaningful effort to really, the great reset. How do we reshape society, which is really what the Marxists have been attempting to do ever since the 19th century, is how do we reorder society and flatten it out? I mean, obviously, it never works anywhere it's ever tried, and there's a reason why it never works everywhere it's tried, but that doesn't stop them from trying to dream into existence this utopian ideal.
Right. They didn't have designer pandemics or designer, they didn't have fentanyl either. So
well, what better environment to really ramp it up, right?
Yeah.
In the post-COVID era where we've got economic disaster that we're not supposed to talk about. We're supposed to believe that the federal government just papered over the economic disaster in 2020 and everything's fine. It's all great. We've got that. You've got people who were, for understandable reasons, very susceptible to that centralized messaging because they didn't know what COVID was. It sounded like this really dangerous, deadly. I mean, in the early days, remember, they made it sound like the Spanish flu. So for people to react in the way they did, it's understandable why they did. That's, I think, Cole, your point. People don't have enough information. They don't know where to get it. They don't know how to break it down. So they're just looking for answers. And anybody who seems to provide them, they're willing to attach themselves to it. I'm afraid more so for the younger people out there, the younger generation. First of all, they're the ones that are getting screwed by all this.
Yeah.
They have no idea what a booming economy actually looks like. At the same time, they've been indoctrinated with this stuff from the moment they set foot in school their entire lives. They've never seen a real economy. They don't know what capitalism is, let alone what it can actually do. They've never seen a free market. And so they're looking for answers for all the problems in society, and they're not finding them from anybody, certainly from our generation. So, why not think about some of these other alternatives? Because what we have now just isn't working.
Jeff, you guys obviously brought up a lot of stuff there. Let me ask you, suppose someone's listening and they're like, what are you talking about? I just looked, the unemployment rate's really low. So what do you mean this awful economy? Can young people go get a job like nothing?
I wish that were true. I mean, yes, the unemployment rate was, at least last month, it spiked up a little bit today, but the unemployment rate at a 50-plus year low. I mean, it sounds like, again, Jay Powell, whenever anybody says, hey, the economy isn't really working out that well, he says, well, look at the unemployment rate. This sucker's red hot. But we all know that's not the true picture of the underlying economic fundamentals because participation problem. We just talked about fentanyl. How about other opioids? The substance abuse problem. We've had a participation problem that dates back to specifically October 2008, which is not some random month that we're just picking out of a hat here. So ever since the economy broke down, suddenly people can't find jobs. And when they can't find jobs, what do? They quite naturally stop looking for a job. And when they stop looking for a job, the government asks you, are you working? And you say, I'm not looking for a job because there aren't any. You're no longer part of the labor force. So the unemployment rate only measures those people who are actively looking for a job. And if we ignore the about 21 million people who stop looking for a job, then the unemployment rate is incredibly low and the economy looks really hot. And the economy is really hot if you have a job. It's not so hot for way too many people who aren't even bothering to look for work anymore. And that only got worse after COVID. The participation problem was pretty bad up until 2019. Then, of course, we shut everything down and everybody was out of work for quite a while. And on the other side of it, as things came back, it didn't come all the way back. We didn't even get back to where we were in terms of labor force participation. We're still well below 2019 and early 2020. So the participation problem got even worse on the other side of COVID, where we're not even in the same categories where we were before 2008. So it's easy, and most people get their perception of the economy from these few major mainstream numbers, right? You think, what do we look at if you're just a regular person on the street who doesn't follow this stuff closely? You look at GDP. GDP, you only look at the quarterly rate. You don't look at how far below it used to be or how far below the trend it used to be. You look at the stock market because we're told the stock market discounts information when the stock market's, pardon my language, utter horse shit. It's a clown show. It's a casino, as everybody calls it. And the other things you look at is maybe the payroll report and the unemployment rate. So people's perception of the economy is colored by an unemployment rate that doesn't capture the full picture of what the economic situation is. And so again, it feeds into this dissatisfaction because the unemployment rate says the economy is really good, but I don't see it in where I am. My neighbors are doing really well. And then we have this massive imposition of consumer prices that makes everybody poorer on top of it. And it's just one thing after another. And all of the right people, the so-called establishment, keeps telling us, We've got everything handled. Don't worry about it. Everything is great and fine. Everything we do works really well. You can understand why people get really pissed off and dissatisfied.
Yeah, besides, obviously some of the macro stuff there. And yes, we've talked with other guests too about how they count unemployment and, some of the tricks involved there. But just anecdotally, so a year ago, I don't know if you guys remember this, around where I am, like all the restaurants were saying, hey, please be patient and kind. We're short staffed. There's a labor shortage. But I knew some teenagers that were desperately trying to get work. And I went to a Friendly's and walked in, on the big sign outside, come in, we're hiring. And the manager's like, yeah, I'm not hiring. I said, but your sign, she goes, yeah, corporate told us to put that up there. Yeah. And it was just like, what the heck is going on? So it was, I would joke and say, if only we knew some economists to explain this, because I didn't know what the heck was going on.
There's never any such thing as a labor shortage. There's only a shortage or inability of companies to pay the market clearing wage. Because if you're desperate for work, you raise the wage enough, people will show up. That's how it's always been. And the participation problem is the flip side of that. The participation problem has always been, is it worth for me to get off the couch and actually get a job that's not going to pay me enough than what I can get just sitting on the couch? I can get by doing nothing. So unless there's a job that's available that's willing to pay me a decent wage and a decent weekly pay, that's really the problem. It's a shortage of work. It's not a shortage of labor. It's a shortage of good paying jobs. It's a shortage of companies that are not willing to, that would be willing to pay what people need them to join the workforce, rejoin the workforce.
Well, if you were Canadian, they had during COVID something called the CERB, which was the Canadian Emergency Response Benefit. It was like $2,000 a month or something like at least a minimum. And people that weren't making that were all of a sudden getting that. And they just closed it recently, like mid-March or something. They just stopped, like 2023. They just finally stopped paying. Like, no wonder. like that just backs up everything that you're saying. Like literally the government was giving everyone money it's the whole thing just like breaks my brain. I mean, if it breaks economists' brains, imagine what it does to me.
So, okay, going back to, again, the narrative, are you... Plenty of people who are friends, people like in our camp, whatnot, they're saying, oh, the dollar's going to crash any day now. Is that another thing that you think is like, no, guys, you got to stop saying that?
Yeah, because we've been hearing the dollar's going to crash for 15 years, ever since the Chinese PBOC head Xiao said, oh, we got to replace the dollar in 2009 in the aftermath of the global financial crisis. And then everything that has happened along the way gets super overhyped as, oh, China's coming for the dollar. They're going to replace it. They're going to get together with Russia and Saudi Arabia and Iran and create this new currency regime. And every year, nothing happens because there's a fundamental misconception about what the reserve currency is, number one. And number two, what is the reserve currency actually supposed to do? Because when you understand the second part, you understand that China is never going to be able to replace the reserve currency to begin with. And the first part is the dollar is not the reserve currency. I hate to break it to people. It's something called the eurodollar, which is even worse because, as I said before, the monetary system is in the hands of this global banking cartel, which is actually worse than as if the monetary system was in the hands of the federal government, which it's not. So we have this eurodollar system, and its role is to make sure that the reserve currency does what a reserve currency does. And up until August 9th of 2007, it did a really good job of providing the reserve currency. So what is a reserve currency? It's not being able to price goods or commodities in US dollars. That's not a reserve currency. That's a byproduct of being a reserve currency. Reserve currency means having enough intermediating medium all over the world in as many places as possible, as accepted in as many places as possible, so that very different countries and very different systems can easily, fluidly, and efficiently transact with one another. Put yourself in the shoes of somebody in Japan who wants to buy goods from Norway. If there was no reserve currency, you want to buy goods from Norway, you would have to send the Norwegians some yen because that's the currency you have. Or you would have to think that, well, maybe there's some kroner lying around in Tokyo somewhere that I could send to Norway instead, when that's not going to happen either. And on the flip side of that, if you're selling goods from Norway to Japan and somebody's offering to pay you in yen, you would have to be able to use yen in Norway, which you can't do that. But if you have a currency that is both available and acceptable in both of those places, you can easily convert yen into dollars and convert dollars into kroner. Then you have a reserve currency system. But in order to be able to do that, you have to have the background and infrastructure, logistics, and a whole bunch of other stuff that makes this reserve currency available in all of these places. That's what the banking cartel did really well, is that it served the needs of the globalized economy to create this really, really beautiful and really elegant reserve currency system that has nothing to do with the US government, has nothing to do with the Treasury Department or the Federal Reserve. It's all about making sure that there's enough intermediating medium between these various different systems. So when people say China is going to replace the US dollar, you always have to say, how? How are the Chinese actually creating a competing system that can replicate these types of tasks, the ease at which these things work all over the world? And the answer is they're not even trying. That's not even what China's actually doing. What the Chinese are doing, along with Russia and the other BRICS nations like Brazil, India in particular, what they're trying to do is reduce the amount of dollars that they have to get in order to transact through this international media, because since 2007, there aren't enough eurodollars in the system that makes the system as fluid and flexible as it had been before 2007. Bringing this back to low interest rates and demand for safety and liquidity. Doesn't matter what the Fed does. The global banking cartel has constricted the amount of dollars in global supply. And this move by the BRICS nations to do bilateral trade is a symptom of that problem, not that they're trying to replace the US dollar.
Okay, so for an analogy, people may have heard stories about how, in the Great Depression or other crises in U.S. history, if money is scarce, people would use scrip. Is that kind of analogous to what you're saying? They can't get the dollars abroad, and so they're saying, let's economize on them. Let's figure out ways we can directly trade with each other without having to go through the U.S. dollar.
Yeah, and we just got an example the last couple of days of the downside of this. Russia has been trading with India in rupees. Russia has been selling a hell of a lot of oil to India because India is one of the few friendly nations to the Russians. But Russia's economy is a complete disaster and a catastrophe, which means that they're not importing any goods from India into Russia. So it's a one-way trade. And as a result, the Russian oil energy exporters have built up about 150 billion worth of rupees. It's actually something like 12 trillion rupees that they can't use because they have all of these rupees. And what are they going to do with these rupees? The rupees are not usable really outside of India. So they're stuck with a currency that they can't use. The Indian government is trying to convince them to invest in India. And the Russians are like, nah, we'd rather not. So in trying to alleviate their dollar problems, they've run into an even bigger problem, which is they're accumulating a currency that they can't use, which is a much worse situation than being unable or being less able to get a currency, the US dollar, that you can use. So the downside of international money and international trade is this problem, which is again reinforces the notion why the eurodollar system is going to remain for the foreseeable future, because it does what no other currency can, including the Indian rupee, which it's not really usable outside of that small little area. And that's true of China's yuan. It's true of Brazil's real, or even if the BRICS got together with their new development bank that they're putting together as sort of a payment processing mechanism, that still doesn't solve the same problem, which is if Russia wants to be able to transact on the global economy, it needs the global economy's medium, which is these eurodollars that are not easy for them to get.
Is there an argument for, say, stablecoins or Bitcoin in this conversation, in the sense that, say, the BRICS nations were to come together, pool all their money, and they would agree on, say, Tether, for example, and they were to buy up as much Tether as they could? Would they be able to kind of compete, say, with the eurodollar in any way if they control the vast majority of the supply of Tether, or, say, Bitcoin for that matter?
They still have to solve the accessibility problem. But yeah, I think in the long run here, and I don't think this is going to be a national solution. I think it's going to be a private solution. But yes, digital currencies are the wave of the future, and they're going to take over at some point. The question is, what does that look like, and when does that happen? I don't think we know what it's going to look like, and I don't think it's going to happen anytime soon. But I don't think people realize that we've been on a digital money standard for decades. It goes back a long, long way. We haven't used real currency in our hand-to-hand currency in any substantial way in the United States since the early 1900s. We've been on a ledger money bank system for a very long time already. And I think that's the last real hurdle to widespread adoption of digital currencies, is realizing that this isn't really that different from what you've been using all along. The only difference is who gets to keep the ledger. In the current framework, it's this global banking cartel. We all think the banks have our own interest at heart, and therefore they're keeping the books on our behalf. Who owes what to whom? When we can replace all that with just a blockchain that's completely transparent. And so the issue then isn't about the technology or its use. It's about, is it available in enough places that it can be usable as a global reserve medium? And that's where things like Bitcoin continuously come up short. They're not elastic enough. They're not available enough. They're not going to ever be available enough in enough widespread places that it can do what the US dollar does or the eurodollar actually does. You can't walk into a store in, say, some corner of the globe and buy some good or service with Bitcoin. I know people that, just give it a while, it'll happen. In the same way that I could go all clear across the world, take out my little piece of plastic and credit card and stick it in a machine, and I get goods and services, even though we don't really think about how that happens. And it's the how that happens part that you really need to think about in terms of recreating the global reserve currency. So I don't think it's a political question as much as it is a usability question. And the usability, I like, Cole, what you said, stable coins are working on this particular aspect of it because there is a need, there is a desire to fill that role, and there is the technology to be able to do it. It's just, I think we're a couple generations short of it.
Just a point of nomenclature. When you say eurodollar, you mean what specifically?
Well, a eurodollar technically used to be an offshore claim on actual US dollars. And when I mean actual US dollars, I mean physical Federal Reserve notes, little pieces of paper. Physical pieces of paper, hand-to-hand currency, as I just said, that hasn't been a big part of any major economy in over a century. You think about it. When you write a check, you're not actually using physical pieces of paper. What you're doing is writing a piece of paper, a derivative form of currency. You're giving it to the bank that then processes that payment on your behalf. And you think, well, maybe the bank is transferring these physical pieces of Federal Reserve notes back and forth, but that doesn't happen either. We have all of this background infrastructure that's digital. It's all based on bookkeeping and ledgers and everything else. So we've been using a non-currency standard for a very long period of time. What the eurodollar did was take that another step further, which was, if we don't need these physical pieces of paper to settle monetary transactions, all we really need is to keep them in a shared ledger that the bank cartel all agrees to keep. Then we have a monetary standard without actual money or currency involved in it. So where the early eurodollar used to be technically a claim on offshore US dollars or an offshore claim on US dollars, it came to be an entire self-contained monetary system that calls itself the US dollar, but is really this ledger system where banks are keeping track of who owes what to whom in a fictional currency setting.
Partly the reason I would want, because number one, just in case there's some listeners that thought, like, what is it, like euros mixed with dollar, like to explain, that
it's the ECB and the Fed had an illegitimate bastard.
Right, yeah, they got drunk one night. But then to drive home to the listener where Cole was coming from, that if really what we're just talking about is claims on dollars, then you could imagine that, yes, stable coins pegged to the US dollar could help fill that gap if for other reasons, regulatory or whatnot. There's a scarcity of people being able to get solid airtight claims on US dollars. If to the extent that the public began to trust stable coins more, that might fill that gap.
Yet I think stable coins will eventually evolve away from that, where they don't need to be pegged or they don't need to have a reserve asset that's somehow tied to the US dollar, just become useful and prove themselves as stable. They'll do exactly what the eurodollar did to the Bretton Woods system. The Bretton Woods system was undermined as it was enforced for decades by this growing eurodollar mechanism, which is essentially just because the world needed the supply of money, the supply of reserve currency that the banking cartel was only too willing to supply, and do so and innovate and experiment and do all of these different sorts of monetary formats, things like currency swaps and derivatives that just blow your mind, that go way beyond our traditional senses of what goes on in the monetary system. Once a digital currency or a cryptocurrency, a stable coin or whatever, proves itself in the same kind of fashion, it becomes usable. Therefore, it doesn't necessarily need to be linked to the US dollar or what our conception of the US dollar is, or some form of reserve asset anyway, because when you get down to the basics, money is entirely about faith. It's always about trust. It's not really about the physical rock that's sitting in front of you or the physical piece of paper with a government printing on it. It's about whether or not you trust it, whether or not you trust the person who's using it with you. And if you have enough of a critical mass of people who are using a eurodollar, which doesn't really exist, but for lack of a better term, if they're using a eurodollar or a stable coin, and as long as they think that that system is relatively stable and relatively predictable and reliable, and it allows for business to do what business does best, they'll start using it even if it has no sort of official backing or any kind of tangible convertibility.
Yeah, I think we'll see the next bull run will be very interesting. I think when it comes to, say, stable coins and adoption, if you look at the SEC's position, say, on what happens with Ripple, which has a lot to do with settlement, for example, say competition to PayPal or Zelle or various things like that, bull run adoption of stable coins, there was $1 trillion in 2021 corrected out of the market. If $2 trillion comes back on the bull run, really, what does that extra $1 trillion look like? And I tend to believe that it looks like a lot of the things that we're talking about right now, people moving into what I consider the killer app of crypto, which is Tether. I mean, I think Tether is an amazing story. It's showing absolutely remarkable profitability. It has longevity. It's been around for 12 years. Like in crypto years are like dog's years. It's more like 50 years old kind of thing. And I just really, I'm curious to like watch projects like that, watch Ripple, for example, watch Tether in the next bull run. I'm just a fan of everything that we're talking about. Obviously, it's my passion and my career, but I'm also a fan. And I can't wait to sit back and watch mid-bull run, whenever that happens, projects like Ripple, projects like Tether, USDC, Circle even, where Bitcoin, this is all fascinating stuff.
I agree with you. I'm actually a trustee of a cryptocurrency project, a stablecoin project too, because I believe in it just as much as you do. But I hope we don't have another bull run, because I think that's actually self-defeating. Because
that's a whole other story.
Up and down cycles, and I think there's probably more of them to come. There's always that danger. There's two dangers, right? The first danger is that it's going to turn off people who get the wrong idea, that they think, well, Bitcoin's price goes up and down so much, I can't ever use that as a stable form of money. Right. And that's a legitimate argument. And the other problem is, of course, as you just mentioned, the government's going to get involved. And we don't want the government to get involved. And it might be good that, if a couple of crypto projects become lightning rods and focus regulatory attention on those so that everybody else can actually do useful work. But there's always that danger that government becomes a little too interested and decides it wants a big share of what everybody's creating. And let's not also forget, the banking cartel is not going to give up its cartel status without a huge fight. And right now, all the money and power and influence is on the side of the banking cartel. And when it gets to the point that digital currencies are starting to threaten their cartel status, they're not going to be afraid to use every means at their disposal to try to do something about it. So I think the digital currency is out of the barn. It's too late to get it back in. In fact, it's everything. There's more and more of them every year, despite the ups and downs, despite the boom and bust cycle, because these are good ideas. As you mentioned, Cole, the technology is proving itself, but you always wonder if maybe one of those boom bust cycles doesn't go too far, too much government response, too much backlash from the bank, too much mistrust from the general public before it's really ready to really establish itself on a firm footing.
You just said something, Jeff, that leads into the question I want to ask too is, so I don't know if you were there for George's opening talk, but George Gammon at the Rebel Capitalist Live, folks, is what I'm talking about, has been warning people about a central bank digital currency and just saying, look, it doesn't have to be Fed coin. It can just, just more of a thing of, hey, we're going to take people's liabilities and put them on the Fed's balance sheet sort of thing. But privately, some people were, when I was talking about this more publicly, I got some feedback along the lines of, you guys warning about a CBDC, you're crazy. The private banks are never going to let that happen. That would cut them out of the action. They own, like literally in the case of the Federal Reserve, they own the central banks. So no, you guys are just scaring people for no reason. That's not going to, don't get us wrong. They're tightening the vice in all sorts of ways on the financial system, but the specific fear of, oh my gosh, there's going to be a CBDC that we're all going to be using just this one currency that the central bank controls, they can turn us off. I was getting feedback saying no, the private banking cartel is not going to let that happen. I'm wondering if you have any thoughts on that.
Well, CBDCs aren't actual cryptocurrency projects. They're not digital currencies. They're not usable. They're not useful. They're not even robust. And central banks know it. I've talked to people who worked on some of these projects and they just laugh and shake their head because Governments are not actually taking them all that seriously. Talk to somebody who worked on a project with the BIS, and they're just doing it just because everybody's talking about digital money. They're not actually interested in setting up a central bank digital currency. They're just trying to tell the public they're in the same realm so that they can then say, don't worry about this. We have all of this stuff covered. And we've seen any number of the CBDCs that have been launched have been riddled with problems because, again, central banks are not taking them serious. They're not investing in the human technology or the capabilities that digital currencies are. So even if they do launch a CBDC, like the Eastern Caribbean digital currency project that launched last year and then was promptly offline for 2 straight months, I mean, that's the type of threat that you have. Even the Chinese digital currency has been a complete failure. They're not actual digital currencies in any meaningful respect. They're almost baby projects. They're pilot projects that are just exploring what maybe they could look at that private digital currency projects are already doing. And I think in a lot of ways, they're only doing it to try to appear that they're catching up to what the private sector is doing, so that as the private sector continues to hit more and more milestones and more people start to say, hey, what's going on over here? The central bank can say, oh, we're working on the same stuff. Don't worry don't pay any attention to that stuff. We've got our own over here that we're working on, when they aren't actually working on any serious projects at all.
The thing that was fascinating about this subject to me in George's presentation is that he was basically saying, the CBDC is just like a big whole thing of smoke and mirrors. It was like, let's get people really excited and worked up. And let's get everyone thinking that CBDCs are these really bad things and get them all like kind of focused on them and talking about them. When all we're going to do to solve this social credit score issue is implement like IRS point of sale systems, like in actual like Chipotle. And so now they can roughly tell how many burritos they sold, but they're going to be able to tell, was it a burrito with tofu or beef? And if you had tofu, you get a higher social credit score. And if it was beef, you get a lower social credit score because you're like woke, I guess, if you're not woke if you're eating beef. I don't know. Sorry, I digress about the woke stuff. But it doesn't, the point is that like the CBDC doesn't matter. It's like a burning building or a burning bank, and all the first responders go while really the crime is happening over here.
Yeah, it's much easier to do what you just described than it is to start from scratch with a central bank digital currency, isn't it? Just to piggyback off the existing infrastructure. And as we talked about earlier, if the banking system is only too willing to share this power and influence of this payment processing network that they've developed over the decades, why go through the mess of a central bank digital currency? It's not going to work anyway. It's going to be riddled with faults, and you're just going to turn people off to begin with. So, Cole, what you're saying, I mean, it's much easier to do it that way, let's just work in the background. Let's use some of the banks. Bank of America will share depositor information with us if we ask them to anyway. So why do we go through the hassle of trying to create something new? But we have to pretend like we're creating something new so that we can say that we're keeping up with technology as it evolves. When, as you said, they're looking around the back door and in the back alleys and finding all these other ways that are much easier and simpler to exercise all the influence and control that they've been looking to do for a very long time.
Well, I'm looking at the clock here, Jeff, and I want to make sure I ask, and feel free to put whatever caveats you want. But for business owners, they're following all this conversation. Yeah, this is great, hypothetical or theoretical, but what's the news I can use? Like yield curve's inverted. Do you agree? Does that mean a recession's coming, like a lot of people say it means, or does it not necessarily mean that? Or it sounds like hyperinflation's not coming, so do I not need to be stocking up on gold and crypto?
Again, that was the point of the presentation at George's conference, was to say that interest rates are telling you everything you need to know about the macroeconomy. And by resisting the Federal Reserve's interest rates, by inverted, which means lower rates are going lower, both in terms of cash rates as well as forward rates, the markets are saying is that safety and liquidity are going to be in high demand. And it isn't too hard to figure out from there why safety and liquidity would be in high demand. We've got a banking crisis. We've got an economy where even regular folks are talking about recession. Not talking so much about consumer prices anymore, though that's still a big problem. So the markets, the economy, everything except the unemployment rate is pointing toward not just recession, but a deflationary recession, which is among the worst of the worst kinds. I've been calling it a 2008 style scenario that the markets have been pricing since last October and November. And everything that has happened since October and November would make you think that this is exactly right. Everything that has unfolded since these curves really inverted and really got into this deflationary shape, it's completely consistent with the idea of a 2008 style scenario. And even after, Silicon Valley Bank and Credit Suisse, let's not forget this is global, The market didn't say that was it. That was the worst of it. It actually got worse. Market said, yeah, this is confirmation of everything that we've been afraid of. This is why we're hedging for lower interest rates, higher demand for safety and liquidity, because we're still moving in the direction of a deflationary recession. So more banking crisis, more breakdown in the economy, and at some point relatively soon, the labor data is not going to look so robust as it might today.
Amazing stuff. Well, I don't know about you guys, meaning the listeners, not Jeff and Bob, the experts, but I learned a lot today. I'm inspired to learn more. And all I can say is, if you didn't understand some of the stuff that Jeff and Bob were talking about, Google it, go learn about it, get hard, challenge yourself. This stuff is vital. That's why this show exists, is to be able to put information in front of you that challenges you. And if you're a business owner, you're a would-be founder, you are a founder, all of these things are vital for your success. So, Jeff, I wanted to thank you on behalf of Bob and I for being here today. That was one of my favorite conversations that we've had in the show. We look forward to having you back sometime in the not too distant future.
Oh, that would be great. I'm always happy to talk with people who are interested. And just to echo what you just said, it's the same thing. Don't ever take my word for it or anybody else's word for it. Do your own homework. Ask questions. If something is bothering you, do the research. I think that's really the most important point in all of this is information is the best thing here.
Well said.
Great. Thanks, Jeff. Thanks, everybody, for tuning in.
This concludes another episode of the Founders Forum. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the hosts and for previous episodes, visit foundersforum.io. Thanks for listening.